Well, City Pacific froze redemptions from a $1 billion fund this week, which is why it was Tom Elliott's Loser of the Week. The company is blaming the media for much of its plight, but as Kathy Swan reports, there are some ugly similarities with other disasters among financiers that have been using small investors' money for big developments.
For diversified financial services company and non-bank lender City Pacific, times are now far from tranquil.
Smart first buyers moving into homes worth far more than they paid. Don't miss the boat.
Its enticing spiels to investors have been swamped by a series of events that saw City Pacific shares butchered by the market, then suspended earlier this week. Company management's blaming the media, but others are looking to the release of a corrected version of the company's accounts after the markets closed last week.
It's the concern that there aren't careful checks and balances. There isn't a clear understanding of the financial position of the company.
Financial advisor Scott Francis says City Pacific has two distinct sets of investors now vulnerable, those who've bought shares and those who've pumped money into its mortgage trust.
Shareholders obviously have already been exposed to a lot of volatility, and they need to be thinking carefully as part owner of their company as to what is actually happening in the company. For investors, they'll be really relying on City Pacific and the other people who will be involved in providing information now just to see exactly what the situation is.
If City Pacific shareholders were startled by Monday's 20% fall in the share price, then they'd have been seriously agitated by Tuesday's 50% dive to a low of 81 cents. That dramatic drop prompted an ASX "Please explain," which in turn saw City Pacific ask for a 2-day timeout and trading halt, which was later extended until next Tuesday as the company frantically tries to reorganise its finances.
Unless City Pacific can provide a more detailed and current disclosure, or they can show that they've obtained fresh wholesale finance or perhaps even direct institutional investment, then the shares are plainly vulnerable.
Independent banking analyst Ian Rogers says it's too soon for investors in the First Mortgage Fund to know which way their funds will go, as City Pacific continues discussions with 3 parties over the joint venturing, refinancing or sale of some of its significant assets.
Indeed, it might be, if that it is well managed, that there are no losses at City Pacific, and there are scenarios in which City Pacific and its mortgage trust can keep on trading. The trouble is that Commonwealth Bank is seeking to recover $90 million of a $250 million loan, and they want that by the end of March, and then there are other payments due by the end of April.
April's outgoings include a promised $30 million dividend to shareholders.
At the end of December, they only had $2 or $3 million of cash in the bank. This is within the corporate entity, not within the trust. And the chatter around the place is that they're often struggling to maintain cash balances. So they may have loan repayments within the corporate vehicle that will enable them to fund the dividend, or they might be able to raise a loan or investment from some other source. But as it stands at the moment, the likelihood of the payment of the dividend is low.
City Pacific says it's expecting to be repaid $326 million it loaned out from its mortgage trust by the end of March, with a further $707 million to be repaid by year's end. Investors, though, are already clamouring for their money back, but City Pacific shut the window on that growing queue by freezing redemptions on its $1 billion first mortgage fund for at least 6 months.
What it means is that if any retail investor were willing to invest in the mortgage trust of City Pacific at the moment, in practice what they're doing is assisting City Pacific to pay down Commonwealth Bank.
The ghosts of recently failed entities like FinCorp, Westpoint and the like would no doubt be haunting investors who now can't get to their funds as they consider possible similarities in structure to City Pacific.
One is that generally the money that's been raised from investors is being on-lent for property construction projects, and they're inherently risky projects. Second is there seem to be reasonable level of fees that are coming from the schemes.
What Westpoint and FinCorp and Bridgecorp and a number of New Zealand finance companies that failed all have in common, and which you can wonder about whether or not the same issues apply to City Pacific, is that they're really just construction financiers and development property financiers, and they lend their money to projects they may already be managing, or to parties closely related to them, or just to a narrow network of property development mates.
Investing in property development always carries risk, but now interest rates are rising. So are the risks for developers and their financiers. That means the likes of City Pacific face much tougher competition for a fresh flow of funds when there's a risk-free 8% currently available in the form of boring old bank bills.